Welcome back to Market on Close. It is the closers panel. 10 minutes away from the end of the session right now. We've got Bob Iaccino. He's the founder and chief strategist, Path Trading Partners. Bob, welcome back on the panel.
Good to be here. Thank you.
We've also got Alex Coffey joining us, senior specialist on the retail trading desk, and Stephanie Lewicky, a senior manager of futures and forex at TD Ameritrade. Welcome to you both as well. All right, Bob, let's talk some crude before the bell here, right?
Sure.
It's a little bit lower today. What are you doing right now in crude? Is it stalling out or is it about to keep ramping higher?
So it's interesting. I wrote a piece this morning on the effects of the polar vortex on commodities.
Okay.
And you would think most of that would be in natural gas.
Right.
Obviously, that early spike that we saw around mid-January or so was based off of that.
Huge spike.
Yeah, but as AccuWeather started to say, there's no real reason to think this is going to last out, given some of the inventories you saw it pull back and it's sold off ever since.
I mean, nat gas, by the way, if we can just address this real quick, it even collapsed even harder than it did last time. 2.66 right now.
Yeah, I mean, obviously, I wore shorts here. I mean, it's beautiful out today. So who needs natural gas?
Right, 40-degree weather here in Chicago.
The crude oil story was kind of ignored. I mean, people were holed up in their houses for 3-4 days at a time across a span of about 250 people in the U.S. They were all affected. I happened to be in the great state of Florida during the polar vortex, and people were holed up in their houses there because it was 51. They weren't going out, they weren't going anywhere, so you're actually going to get some increase of gasoline supplies in the coming numbers. It might not be this week, it might be the next week, which is probably why this is stalling out a little bit. And on top of that, the Venezuela thing is always,
does it matter to
enough,
markets right now?
No, I mean, I think most of it was taken out, but just the news headlines tend to hit that front month, whether it's bullish or bearish. And then we've got Brazil actually increased their production of crude oil by 4.8% from November to December and 3% year over year. So there's more supply. So all that hitting the market at once, I think kind of people got out of good positions, we got out of positions in crude oil.
Okay, Stephanie, when you look at what's going on with crude right now, all those are important factors, and it doesn't even then get to the overall kind of big macro picture, which has been pretty solid data here. Obviously, another massive employment report last week. We know that the stock market has been rallying, but crude's rally, timing-wise, goes with stocks, but it hasn't quite been able to have the same gusto as the equity market comeback.
Well, I don't think it's had the same gusto, but I think if you track the ES next to crude, I think both of those are tracking pretty closely. I think you saw crude come off a little bit today because we had some strength in the dollar. I mean, crude then kind of popped back up close to its high today, but we have had a weaker dollar in the last few weeks, definitely a bit weaker than we've seen in 2018. So you're seeing stronger crude, and I think crude has had, again, just it's been having a nice comeback. The employment, the numbers on Friday has helped it. We continue in the U.S. for the most part to have strong economic data. To Bob's point, some of the Venezuela news, I think that's already kind of been priced in. I think the market's kind of over that right now, and it's looking strong, sitting around this 55 level.
Yeah, there it is compared to the SPOOs as we see the market really rallying back. Alex, we talk here about companies, earnings a lot. We've got Chevron, we've got Exxon, but it seems like from the stock play, it's very murky. You've got Exxon that's kind of down today, even though Chevron and ConocoPhillips are up. There continues to be a very difficult investment thesis, I think, in the companies.
Yeah, it's tough to say because, I mean, I don't have the exact updated numbers, but before earnings last week, I looked up some of the correlations between those companies and crude oil, and it was like in the mid-70s, which was a pretty high correlation. Okay. But then I looked up just the S&P 500, and it was like 72%.
Right, it's actually higher than the energy companies.
It wasn't necessarily high. It was higher than Chevron, I want to say, but it was pretty close. Like, it wasn't a big enough difference for me to be like, if I'm investing in ExxonMobil, I'm investing in the direction of crude oil. So when I look at that, I know that's something that Bob can talk to a little bit more, because I remember him saying that, if I'm going to invest in crude oil, I'm just going to trade crude oil, because then I'm actually getting exposure to what I want. But when I look at this, the 55 level does seem significant in crude oil because we've kind of danced around that. But if I'm looking at this from the perspective of the energy companies, I think just some type of a stability at some price level is probably what they're looking for. When it's going from 77 down to the low 40s and jumping back around, it's hard for them to project their revenues, project what costs are going to be when it's jumping all over the place.
Which was very apparent when crude oil was up 69% between June of 2014, April 2016, and Exxon was down 9.4% as a stock. So I think that's the point Alex is making. Those correlations, 70% is a good correlation, but it's not 100% correlated to crude oil like crude oil is.
Yeah. They also said at a Goldman Energy conference a couple weeks back, we talked about this at the time, Darren Woods is the current CEO, but it was actually, I believe, the CFO that talked to the folks, actually it was CEO Darren Woods at the Goldman Sachs Global Energy Conference. This was on January 8th, and he said, look, we're not really looking to buy anything in the Permian right now. We're not looking to tack on smaller companies because we don't think we can extract much more because they're so basically efficient at this point, which I think is another interesting facet into what we've talked quite a bit about, which is what's happening in the Permian, whether or not those problems are being resolved, and then if that's going to be price bullish, if it's going to be price bearish, and whether or not it's for the commodity or the companies. It's like, I have no idea what the resolution for that situation means at this point for crude.
I don't either, except the transport problem. I know what the transport problem does. Solving the transport problem stabilizes prices, because when there's a transport problem, there's a fire sale in those basins to get rid of the crude that's already out of the ground. One thing I know about American companies, if they have the wells, whether it's at $1 a barrel or $100 a barrel, they're going to pull the oil out of the ground and try and sell it. So when they get those transport problems solved, now they can negotiate price a little bit better and stay closer to WTI. So that idea that the actual front month price has to come down to meet what's happening in the field kind of goes away.
Yeah. All right, we're going to, how much time we got, guys? We got a closing bell that's coming up here in a moment. But before we get to that, let's talk a little bit about what's been going on today. Because Stephanie, we had a market that rallied. We're going to close near the highs. The Nasdaq's up 1.1% after starting off this morning when we opened the bell. This is quite a Monday to get things started here on the week.
It's a very boring Monday, I thought. Not a lot of action in the market after last week. We had so much news come out, and the market did trend higher last week. All the indices closed up just about over 1%. But today, factory orders came out. The number a negative 0.6 versus a positive 2%. So not a good number. The market didn't seem to really care. The market shrugged it off, and then we just kind of trended higher all day long this morning. And I think maybe today it's waiting on the big Google earnings report after the close today, with NASDAQ leading the way for the indices right now.
All right, we're going to hit Google in a few moments here. And with closing bell, we're going to hit some movers with Nicole Petaliti. Stick around. Bob Iaccino's with us. We got to talk about this market doing a 2017, maybe doing a 2016. The Fed turns dove and tech floats to the moon. We'll be right back on the TD Ameritrade Network. Welcome back to the TD Ameritrade Network. Microsoft closing the bell at the NASDAQ market site with a day that looks pretty positive for equities. What a move, up 1.2%. NASDAQ climbing. 10-year yields also climbed a little bit to 2.7, but today was very much a FANG-driven rally. Netflix up 3.4%, Facebook up 2%, Apple 3%, and Alphabet climbing into its own earnings report, which will be coming after the bell here in just a moment. We'll talk about it as those numbers come in. But really just gains that, while not unanimous, there were some down stocks after earnings and other moves. We talked Celgene falling after the Starboard stake in BMY might change that deal's possible result. But right now, overall, healthcare as a group kind of slowed its roll a bit today as we looked at some of the big pharma companies. There was a Barron's article, of course, over the weekend we talked about this morning, adding on to speculation of what higher drug prices are going to mean. And for healthcare, that's a big player in the momentum group now, which means today, MTUM, one of those factor ETFs, was actually a little changed despite the big pop in tech. So it was a growth-driven day. Volatility dropped below 16 for the first time since October as VIX closes at 15.67. Let's go to New York at the NASDAQ market site. Nicole Petaliti is with us. All right, Nicole, quite a bit of a rally to kick off a week without a whole lot of news, right? Some earnings, but the big one hasn't even come yet.
I bet you a lot of people are really excited. Look what's been going on with Apple. I mean, Apple's been a clear leader. It's been running the show for the last few, right? It came out with its numbers, and it's been moving higher. It's been a best performer in the Dow Jones Industrial Average today, along with Microsoft and Boeing. So not a bad day on Wall Street as we sit here with bated breath waiting for Alphabet, Google.
Yeah.
So that's one, and we've covered that inside and out, but we're certainly waiting on those numbers. I mean, that'll be very key to see whether or not they can bring it.
All right, so the takeaway then is what? I mean, we talked earnings this morning. We talked one of the most read notes on Wall Street, David Kostin at Goldman Sachs. Not exactly the most bullish take, but yet market is taking its cues from, what's the read, Nicole? Is it just post-Powell, the Fed's got the markets back, let's go out and buy some tech, buy growth stocks?
Yeah, and you know what? And you saw that in Kostinen's note. It actually had inflows, outflows over the last, whatever it was, several months. And you saw, like, over the last few weeks that money has been coming back into market. People need to put cash to work. It's been sitting on the sidelines. You have them talking about earnings revisions that have been to the downside for energy and tech. But, Richard Bernstein, who is the former chief strategist over at Merrill, actually said, concerned about some of the numbers and how much the companies have been putting the debt to buy back the stock, right? And goose the buy back stock and goose the share price a little bit, goose growth really, but has a moderately overweight on stocks. Not afraid. It's basically saying the next economic downturn will be milder than what people expect if there's one. So not as worried. So that's the big picture. But I have some interesting news on Apple.
I like
Apple
it.
has so much cash on hand. What should Apple do? So, JP Morgan comes out with this hypothetical situation. I know we've heard the idea before, but let's break it down. Basically looking at Netflix, Sonos, Activision, because Apple has $250 billion roughly cash on hand, hoarding all that cash, what to do with it.
Yep.
So JP Morgan comes out with this idea, Samik Chatterjee, and saying outright just go buy Netflix. I mean, why even bother trying to get into streaming video and be the smaller player and always be trying to chase Netflix? Just buy it. You still have money left over even if you picked it up for $189 billion. So it would use most of the money, but it would make it the major player in the space. The other ideas that have been thrown around, consider buying video game maker Activision. There's been a big shift in gaming to mobile. And the last would be to acquire smart speaker company Sonos, and by doing that, that can improve their smart home game, because we know that in the smart home and speakers, they've been trailing, right?
Yeah.
Apple is not really the big player in that. So those were three ideas. I will tell you, Netflix and Sonos, if you bought these on December 24th, good for you, because you already made probably 35% in 4 or 5 weeks.
Yeah.
Killer return. Killer return.
They got a ways to chart, but hey, you're right. I haven't even realized Spot, Sonos, both of them sizably off the lows too. I also heard a while back social media Snap rumors. Some saying, hey, maybe Apple could do something better with Snap, but I don't know, maybe not the same oomph as a Netflix.
Well, the other thing is Netflix is number one, right?
Right.
You want to go and kill it and take over the world, then just go get the number one. And that puts them right at the top without even having to try. So that was the idea behind it, and they would have a little money left over. Activision and Apple are both winners this year. Of course, Apple about 10% higher, so that's some good moves there.
All right, another 2.8%, $4.75 for Apple today. Nicole Pedalides, thank you. Nicole joining us from the NASDAQ Market Site. All right. Let's bring back in our panelists. We got Alex Coffey, Stephanie Lewicky with us here from TD Ameritrade, and Bob Iaccino from Path Trading Partners. Bob, are we getting like super lofty peak where suddenly people want Apple to blow half of its cash hoard on Netflix? Is this reasonable? Is this a possible thing that'll happen?
Yeah, I don't think it's going to happen. It's interesting because I think you're going to hear a lot of that as we move further into this rally that we've gotten since about mid-December. Right, you've got Google's a good example. I mean, what does Google need? 115 or 150, about 120 billion on their balance sheet. What do they need it for? They've been quiet in M&A. I think M&A has been quiet when you include those big names. Having said that, it wouldn't shock me to see somebody else get involved with a Netflix. But I don't know about an Apple. It just doesn't seem like their sort of playbook. What was the last thing they bought that we all got excited about?
Yeah. Hey, Alex, we were talking earlier about some of the intraday moves. Google numbers are breaking right now. We're going to give you the update as they come in. I mean, literally just crossing about, what are we doing, about $20 lower. But let's take a look at coming into this, because as we talked about, you had basically kind of the opposite reactions between Apple and Facebook on one hand, Amazon on the other. Now the question is, which way does Google go, basically? Is this as important of a linchpin to the market as, say, an Apple was, apparently, for sentiment?
I mean, we'll have to see like exactly where this actually plays out. 'Cause, I mean, it traded up to almost 1180 in the Class A shares before trading lower. It looks a lot like Amazon did after the close when it reported. But Amazon and Alphabet or Google had not the opposite, I can't think of the word, but I guess the opposite of a benefit of going after Apple and Facebook and some of these other names, and they rallied on all those results. So from what I see, it looks like Google beat the estimates pretty significantly, but it rallied almost 100 points in the last couple days after those other companies. But as far as sentiment, so I brought some numbers in just looking at the Qs. And so if you take FANG and you replace Netflix with Microsoft, roughly, I'm rounding up from 41.9, 42% of those basically of the percentage of that index of the NDX is between Amazon, Apple, Microsoft, Facebook, and Google.
Yeah.
Okay, Google's just short of 9% of this. So yeah, it has a huge weight on it. And if you're invested into the NASDAQ 100 and the Qs, you're basically 42% of it is in these 5 names. So they do move the market because they are 42% of that index.
It's an interesting point because while this is all happening right around the time that Powell obviously took a dovish turn and market spiked that day, I'm not going to downplay the role of Adam Marcus. I think it's a huge part of the market. But the fact that investors are saying that Apple, Facebook, and others maybe went too far in terms of their sell-off and valuation is important because if they needed to correct that much, then fine, maybe we got it out of our system, and these are a huge part of the market.
Yeah, you know what? I saw a stat today too that said companies that are reporting earnings right now, their stock is rising on average 1.12%, and you're seeing that as we just were talking about Apple. So they had a slight beat on, or they missed on EPS with a slight beat on revenue, but the stock is getting rewarded. That's really what we're seeing this earnings season.
Yeah.
You are seeing companies start to really set guidance for Q1 lower than the average 5, 10, I think even
Amazon missed the estimate.
15 years out. Amazon misses. With Google here right now, and you're seeing just kind of what Alex said, same kind of what Amazon says. It does say beat on EPS, on revenue. Kind of have to dig into the numbers more and see why the stock is selling off. But the market, I think, has been just on this upward trajectory because I think Fed, Jay Powell really did put that put in, and it's got a backstop to the market.
Bob, is this problematic if we're getting post-earnings pops at a time when earnings guidance and revisions are still moving lower? It was part of Costin's report this morning. I mean, it's just the numbers we keep bringing down. We're down to like 170 expected for S&P EPS next year. It was like 178 6 months ago. Is that a problem?
Yeah, I think it is. I mean, 36 S&P 500 companies reported guidance so far. 46% of the S&P 500 has reported. And with that number, 70% beat on EPS, 62% on revenue, but 30 have reported negative forward guidance. They've dialed it down, while 6 have reported positive. So when you look at it from that perspective, that's kind of been the driving force behind what we've kind of done. We sold out of Facebook after earnings. It's continued to rally. I don't care. We sold out of Intel.
Took the pop.
We sold out of Integris. We got out of Symantec this morning. We're getting out of all of these things that we caught through the beginning of January because of this negative forward movement.
Okay.
Having said that, I think it continues, but I'd still put us at probably about 60% invested after today as opposed to 100. I think most of the market's probably positioned that way.
So the overall macro view is that we might continue to grind higher in the market overall, but you're tilted more sort of risk averse from some of these companies. Why then? Because the stock specific outlooks you can't get your head around yet, or you are and it looks weak, or what?
Regardless of how you slice it up, 12.4% right now. If that ends up being the blended earnings growth rate, that's the 5th quarter in a row, but it's lower. We're probably going to continue to get lower. If we get a trade deal tomorrow, there's going to be effects on earnings for another quarter and a half from what's gone on until this point. That's what I expect, to be honest. Not necessarily a trade deal tomorrow, but I expect continued positive news. I read the South China Post the other day.
Right.
They were talking positively about trade talks.
Their tone has changed.
Yeah, completely.
Which I think was missed the past month because we were so focused on Powell, to be honest. I feel like there wasn't a lot of discussion about
it.
The
wasn't a lot
situation.
of, I mean, I know you guys discussed it a little bit. Mainstream did not at all. So when you're looking at that, from that perspective, you're saying, okay, this is going to go positive. Even if, and I'm kind of shifting gears on you.
No, it's fine.
Even in terms of a trade deal, if they sign the exact same detail that we had before, and they both trumpet that it's a better deal for both companies, no pun intended. They both trumpet that it's a better deal for both countries. It's the same deal before, we get more growth. So then all you got to worry about is a recession in Europe. You don't have to worry about it here or there anymore.
Because then you remove that overhang on the U.S.-China situation. I said the same thing, which is basically if you get a USMCA version, you know, the NAFTA with maybe a small tweak that everybody, you know, gets excited about. You did that for China. Suddenly this thing is removed. Potential massive headwind reversed, Alex.
No, I think that's an excellent point, and I think part of, I made this comment with Amazon, and we were talking about how they issued conservative guidance. I think these companies, and I don't want to speculate too much, go on too much of a limb here, but they're looking at the same stuff we are. They have all these macro uncertainties out there, and their stocks have been discounted so much. They have that as potential leverage to do this. So whether or not they actually want to issue this, they have a chance to. So if I didn't look at Google's numbers, let's say they issued conservative guidance. If I'm speculating, and they're only discounted down $40 and they're still up over the last couple sessions, looks like a win to me. If Amazon could end that week up with poor guidance, that was a strong, you know, it was a risk, but then they go into the next earnings with lower expectations, makes it easier for them to beat. Like, I just look at this from a strategic standpoint. They weighed the situation of the market and took a risk and said, hey, we're going to say this because we think we can get away with it.
Yeah. The only catch to it, though, right, is that Amazon, because we talked about the same thing coming into Amazon. To me, it made a lot of logical sense that Bezos and team would kind of look at all these things and issue a conservative guidance for the fourth quarter. But then they came out and then they issued a lower guidance for Q1 as well. So I guess we'll just have to basically find out what's behind it. We won't know until we know, right? If there's a stock-specific reason for guidance lowering, then I guess we'll find out if they don't change it when tariffs go away, for example. If something like that were to happen.
Yeah, I think they pay attention to all these other companies out there. You look at somebody like Apple and Facebook, where all they were doing was going down, and every negative headline for Facebook brought it lower. Right. And then Apple, issues guidance, and it takes the stock down to 140. And Apple. I mean, the earnings weren't, blockbuster by any means, and it's already $30 higher. You're just weighing the macro sentiment and how people are interpreting this. I mean, you saw it with the banks. They didn't really blow it out of the water either, yet you saw them all rally together because it's a reminder that, maybe they were over discounted for speculation on what the macro picture is. As Bob mentioned, they ink the exact same deal, that could be framed as good now because at least it's a deal.
Sure. The flip side, Stephanie, is that a bear will come in and they'll say, all right, that narrative might be correct, but that's also based on, assumptions that have to be proven, basically. What they could also just say is, look, right now, we had a Fed that changed course, and it all of a sudden totally turned around the value outperformance of 3 months. Value stocks have been outperforming growth for 3 months since October. You had different stuff besides growth and tech rallying. All of a sudden, Fed goes dovish, and it's like it's 2016, it's 2017 again.
Yeah, and I know you might get sick of me saying this, but I do think this is all. I think this is all the Fed put. I think it's Jay Powell. Apple came out. Guided lower, said slower China sales, and it freaked the market out. Sentiment across the entire market was really spooked. And then earnings started to come out. Earnings have been kind of okay. There still have been some of the companies saying, hey, we are worried about China. We are worried about the slowing global growth across the board. We still don't have a U.S.-China trade deal, but the market continues to rally. The Russell, I think, just closed off of January up 13%. The other indices, NASDAQ up, 11%? Oh, yeah. And so we just continue to to drift higher. So I just really want to see kind of how this plays out if we do get a U.S.-China trade deal, how that affects the U.S. markets.
Bob, to Stephanie's point, because to bring it back to our conversation about what you want to be invested in some of the names that you played on earnings pop and then got out of, because I think a lot of traders, investors watching probably wondering the same thing. They go, okay, I got an earnings pop, is this for real? If it is all about this, 2016, 2017 redux, I'll call it 2016 redux, because we had that moment, Yellen turned dovish, and then we rallied the heck out of that February low in 2016. Does that mean that if that's what's happening now, if Powell has to change course again, or if he does anything besides extreme dove, that this market falls apart? Or are these earnings enough basically to sustain, even if he says, you know what, actually there's one this year. There's one. Or maybe there's two. Anything but zero. What does it do to the market?
I love Jay Powell. It's funny because to both Stephanie and Alex's point, I think Alex put it really well about jumping over that lowered bar. If you look at a think tank like FactSet, for example, that puts out an earnings report card every Friday. It's a very good resource. If you go back, since they've been keeping records, The average beat on EPS is over 70%. The average beat on revenue is over 65% over the entire period of time that they've been keeping records.
The beat rate per quarter.
It's always well above 60, 70%.
Yes.
And that is that game of beating lowered guidance. So that's where I kind of get this sort of weird thesis from. And to Stephanie's point, the Fed was what was calling, why everyone was calling a recession, is because the Fed was not coming off track. This idea that the Fed abruptly changed their mind, it's not like we get weekly or daily communiques from the Fed as to what they're thinking. I always think that's kind of silly. So they didn't, an abrupt change would have been a rate hike and then 2 weeks later, hey, we're probably going to cut at the next meeting in a surprise announcement. That to me is an abrupt turn.
So you argue he's just been data dependent like he said?
Absolutely, that was just data dependent.
Sure.
The market gets surprised by these things and we get excited as people who stare at the screens, that something moved.
Yeah.
So we played these things for earnings based off of what Alex said. Facebook, to me, had been beaten down so badly, and I don't necessarily know if Facebook is undervalued because I've never run a social media company.
Right.
So I have no idea if the stock itself is undervalued. I just know that they had been talking it down so far, and you just look at historical price patterns and behavioral finance, and you say this is likely to beat. Whether that beat is real or not, I'm not smart enough to know.
Yeah. The last thing here that we'll say before we let you go, Bob, is then what sort of information flow are you looking for? Is it really about these earnings? Because if this is more about the sell-off before the earnings and the actual earnings themselves in terms of the low bar being the catalyst for higher prices, does that mean you're going to be more focused on the data and the economic information that's coming not just here but around the world? Because if Powell is sort of a big force for this, then I imagine that might, some would argue, be even more of a force for the market than whether or not we get 6% growth next year, 8% growth.
Yeah, I would agree. I think one of the things I really want to focus on is that earnings don't get too beat up, and that looking at the inflation comments from the Fed, they are likely to let inflation run a little bit hot. Whether they actually said that specifically or not, I don't think they're going to spin back into a rate hike cycle anytime soon. If they do one in 2019, I think they're going to be very communicative that it's the one and that's it.
Yeah.
So based on that, I'm looking for geopolitics, and there's nothing CEOs like better than bad weather or some sort of geopolitics to blame.
Scapegoat.
If they miss.
Yeah. All right.
And we got the vortex too now, so there's that.
All right. Well, we're losing the Bob vortex because we're out of time. Mr. Iaccino joining us on the panel. Great stuff, Bob. Really good to have you here, as well as Alex Coffey joining us and Stephanie Lewicky from TD Ameritrade. Those Alphabet earnings right now leading the stock just a little bit lower by a bit. What are we looking at? Roughly $40. We're going to hit the earnings in detail in a moment. First, we're going to chart some of the big movers of the day. A rally in TurboTax owner Intuit helped lift tech. Yes, it's a tech company. A few other analyst moves. Stick around, and then Alphabet deep dive in 10 minutes.